Hi. I need help. I can't understand what adjusting entries are.
Adjusting entries is fixing up your general journal at the end of the accounting period. It is to record any revenue or expenses that have been incurred but not recorded. For example, suppose that a company sells 12-month subscriptions to its monthly magazine. On October the 1st, the company receives a total of $1,200 for 20 subscriptions. As of 31 of October, the company has provided 1 month of magazines, and has therefore earned 1 month of revenue, being $1,200 divided by 12, which equals $100. Because the accounting system does not yet reflect this earned revenue, the following adjusting journal entry should be made on the 31st of October. You would debit unearned subscription revenue by $100 and credit subscription revenue by $100.
Wouldn't you use credit cash instead of subscription revenue as the business has earned the money?
No. Adjusting journal entries arise because the timing of revenue and expense recognition differs from the exchange of cash. Therefore, cash will never be increased or decreased in an adjusting entry.
What are the different types of adjusting entries?
If cash is received before revenue, then it is called deferred revenue. To adjust the entry, you debit the liability account and credit revenue. When cash is received after revenue is earned, it is called accrued revenue. To adjust the entry, you receivables are debited and revenue is credited. When cash is paid before expenses incurred, it is referred to as deferred expense. To adjust the entry, at the end of the period you debit expense and credit prepaid asset. When cash is paid after expenses incurred, it is called accrued expense. The adjusting entry for this situation would be to debit expense and credit account payable.
Is it true that every adjusting journal entry will affect at least one revenue or one expense account? In addition, every adjusting journal entry will affect at least one asset or liability account. This means that every adjusting entry will affect at least one account from the income statement and one account from the balance sheet.
Yes, you are correct. That is how adjusting entries work.